So when it comes to investing, there's this huge fundamental question that splits even the smartest people in finance. Should you spread your money all over the place to play it safe? Or should you put all your eggs in one basket and, watch that basket like a hawk? Today, we're going to dive deep into this high-stakes debate and figure out which path might actually be right for you. All right, let's just start with a bombshell. Mark Cuban, entrepreneur, billionaire, he does not mince words. His argument is that spreading your money around is actually a recipe for mediocrity. He pretty much says it's a strategy for people who don't really know what they're doing. A pretty bold take, right? But then you've got the legend himself, the Oracle of Omaha, Warren Buffett. And he says something that sounds kind of similar, but there's a really important twist. He calls diversification a protection against ignorance. So what's wild is that both Cuban and Buffett seem to agree, if you really know your stuff, concentration is the way to go. And that sets up our whole debate perfectly. Okay, so first up, let's explore the argument for diversification. This is the strategy most of us are taught from day one. And it's built on a really simple, really powerful idea. Protect what you already have. This isn't about hitting grand slams. It's about making sure you never, ever strike out. This is the art of playing not to lose. And to really get this side of the coin, you have to look at its ultimate champion, Warren Buffett, the absolute master of value investing. His entire empire was built on being careful, on logic, and on patience. He represents one side of this debate. And on the complete other end of the spectrum, you've got a visionary like Elon Musk. But we'll get to his strategy in just a minute. For now, let's stick with Buffett. Buffett's entire philosophy is built on this one core idea of an economic moat. He's always looking for businesses that have this durable, almost unbeatable advantage that protects them from competitors. Like a powerful brand or patents, or making it really hard for customers to switch. Just think of Coca-Cola's secret formula and their brand name. That is a moat. And his strategy, when you break it down, is beautifully simple. He only invests in businesses he can totally understand. He looks for really solid companies that the market has kind of beaten up unfairly, and then he buys them for less than what they're truly worth. That discount, that's his margin of safety. And then he just holds on, sometimes for decades, and lets that value grow and grow. And this brings us to the real gut punch argument for playing it safe. As one person in a Reddit discussion put it so perfectly, we only ever hear about the massive success stories, right? The Elon Musks. We never hear from the thousands of people who bet big on the wrong company and lost absolutely everything. That's a textbook case of survivorship bias, and diversification, that's your shield against it. But hey, what if not losing just isn't enough for you? Well, that brings us to the other side of the debate, concentration. This is the high-stakes, high-reward strategy. This isn't about protecting your wealth. It's about creating it, and creating it fast. This is playing to win. Elon Musk has famously said that Buffett's moats are lame. Yeah, he really said that. He argues that in the world we live in today, a world that moves so fast, the only real competitive advantage is the speed of innovation. It's this idea called dynamic capabilities, which basically means a company's ability to constantly create and adapt is its true defense, not some old-school asset. And this quote from a Reddit user just perfectly captures that all-in mindset. They shared their story of putting a massive chunk of their entire net worth into a single high-conviction bet. Why would they do that? Because they just weren't willing to accept average market returns. It was a calculated risk for a shot at a totally life-changing outcome. You see, Musk isn't looking for companies that are on sale. He's trying to create entirely new markets. Tesla, SpaceX, Neuralink, these aren't just businesses. They're all attempts to solve huge global problems and completely redefine what we think is possible. In his world, profit is often just what happens when you achieve some revolutionary goal, not the main objective itself. Okay, so you've heard both sides, and you're probably sitting there thinking, you know what? I'll just stick with my safe, diversified index fund. But, and this is where the story takes a really fascinating turn. So let's talk about the most common diversified investment on the planet, an S&P 500 index fund. It holds stock in 500 of the largest U.S. companies. Sounds about as spread out as you can get, right? Well, maybe not. Because most of these funds are weighted by market cap, which means the bigger the company, the bigger its piece of the pie. And the results of that is that the top 10 companies alone make up nearly 30% of the entire index. Your diversified fund is actually making a very, very concentrated bet on just a handful of tech giants. Now, that is a pretty provocative way to put it, but the point is so powerful. Your index fund isn't an equal bet on 500 companies. It's a bet that's heavily tilted towards the biggest winners. So the key takeaway here is that concentration isn't just for risk takers. It's literally built into the fabric of the market itself. So what are we supposed to do with all this? If diversification is really just a hidden form of concentration, is the whole debate totally meaningless? No, not at all. The real answer isn't about picking a side. It's about understanding when to use each strategy. This one simple line, we saw it over and over again in the discussions we looked at, and it is the absolute key. The two strategies aren't enemies, they're just tools for different jobs. You use concentration when you're trying to build your fortune, and you use diversification once you have a fortune you need to protect. Think about it like a journey. Most successful people start with concentration, not just in stocks, but in their own career or their own business. Then, once they've built up some serious wealth, like Bill Gates did with Microsoft, their whole focus shifts. They start selling off parts of that concentrated bet and diversifying to make sure that wealth is going to last. It's a totally natural move from playing offense to playing defense. All right, so we've unpacked the philosophies of giants and the wisdom of the online crowd, but the final question, well, it really comes down to you. Look, there is no single right answer here. It all depends on your own financial goals, how much risk you're comfortable with, and just where you are on your own wealth journey. Are you at a point in your life where you can afford to take a calculated shot at massive growth? Or is it time to protect what you've worked so incredibly hard to build? Figuring that out is the first, most important step to building a strategy that's truly right for you.